Market closed on Friday, the 1st of April. For the week, we've lost some ground. We've given up 12,000 crowns for the week. But year to date, we're still up 338,000 Swedish crowns, thereabouts. And that translates to around 32,000 euro, or roughly 35,000 US dollars. And so for the year, we're up 20.5%, and we've basically gone sideways, trended sideways since the start of February. And interesting to note, if you look at the broad markets, they've actually rallied up quite big in the last couple of weeks. A lot of the portfolio is exposed to US equities, and so whilst they've also run up along with the broad markets, you see that this hasn't been shown on the graph, and you see compression. Taking a look at the S&P, we see over the week it's gone up and down, but it's pretty much trended sideways. And that's also the same kind of story with the Nasdaq. It's only up 0.6%. But as we zoom out to longer time frames, we see discrepancies start to emerge. The 3-month time frame, I'm outperforming the index, and the trailing year, I'm up 41.74%. Taking a look at the Swedish krona US dollar currency relationship, we see that in the last 3 weeks, the dollar's lost strength to the tune of 6.1% over this time period. One of the key reasons why there's been pressure downwards on the dollar is because Russia in the last week have mandated that they want payment in oils, in rubles, instead of usual currency payments in the euro or the US dollar. And this also comes off the back of Saudi Arabia negotiating with China only 3 weeks ago, that they also want to settle oil payments in another denomination, in the Chinese yuan. So this changes the supply and demand dynamics of the dollar, and we'll have to keep a close eye on this to see how this unfolds, as you could have drastic ramifications for US denominated assets for foreign holders. Taking a quick look at portfolio composition, we see the vast majority of my holdings is in finance sector. Makes up a quarter of my portfolio. Most of these buys were made early. Most of the biggest buys were made early on, started last year, and I'm currently trying to build up positions in JP Morgan and Citigroup. The second biggest allocation in the portfolio is in energy, and the run up in oil in the past year, and especially this year, has bloated this portion of the portfolio up to 19%. So if we go back and take a look at this pie, we see how the rest of the portfolio is compiled. When it comes to portfolio management or stock selection, I'm not like other people. I don't spend hours obsessing over reading balance sheets and 10K and 10Q filings, or looking up chart patterns. I stick to some basic fundamentals, and I stick to broad themes. I make approximations. Those two sort of go in hand with each other. I only buy strength. I hold for the long term. I buy on a contrarian basis, and I make as little movement as possible. I don't do qualitative or quantitative analysis because it's just an elaborate way of arriving at your own confirmation bias. Any attempt at in-depth analysis of a balance sheet is just approximations in the best case. So the use of accrual accounting makes it near impossible to accurately assess the company that you're trying to evaluate. I also don't listen in on conference calls and try to decipher hidden meanings in the question and answers to the CEO or other officers, because we're so far removed from the brain trust of an organisation. And by the time we get the information, it's already second or third hand information, and it's already been discounted by institutional money. And the more information one wants to take in to try and make an informed decision, the more noise one takes in. And so this can drastically disorientate your decision making. So for me, who wants to spend their time traveling around and involving themselves in another culture, another country, and another people, I don't want to be spending my time head down in all this information and the news and the current events in the world, when the philosophy that I've arrived at personally is that it's all futile. Making approximations is similar to sticking to broad themes. In my case, because of the corona mandates and the disruption of mobility domestically, internationally, I anticipated or approximated that there'd be supply chain issues and supply chain bottlenecks around the world. On the other hand, in unison, the central banks around the world drastically increase the money supply by the printing of more money. This would cause, at some point, inflationary pressures. So with this information, for me, the decision is easy, and it was just to buy strength in US multinationals with robust balance sheets, and they were strong enough to hold any sort of downturn or recession for uncertain times. And even these precarious times, with what's going on in Russia and Ukraine and the ramifications of the fallout that could occur, these companies should be able to withstand all of this uncertainty. The next 3 bullet points are the hardest to do, and where the asymmetrical reward comes from, and that is to hold long term, make as little movement as possible, and act in a contrarian way. But it's definitely where outsized returns can be made. Because we are a social species, we want to fall in line with general group think. So going in the other direction is often the most difficult thing to do in investing. But oftentimes it can be the most lucrative thing to do. So my 6 months in Mexico has come and gone, and we left there last week. And currently I'm doing this video here in Nicaragua, in San Juan del Sur. And it's here where I'll be looking, keeping an eye out on what unfolds next in this precarious time that we're all going through at the moment.